Welcome back, you legends. I'm Dr. Cal, and let's get straight into today's video. Basically, legends, every single trend indicator that we follow, every single one has printed a sell signal as of this morning. Every single one. That includes the daily chart for the S&P 500. That includes the summation index for the NASDAQ composite and the S&P 500. So that's number 2. Number 3, the VIX. Number 4, the DXY, the dollar index. Number 5, the US 10-year yield. Number 6, the 50 and 200-day breadth charts. Number 7, the smart money forming a bearish divergence. Number 8, XLY divided by XLP, the ratio chart forming a bearish divergence. So we have A, bearish sell signals, 0 buy signals, no buy signals in any of the indicators that we follow, all telling us the market is stopping, the uptrend is ending, the downtrend is now beginning. Everything is happening exactly as we warned last week. Look at this, legends. This is the S&P 500, NASDAQ 100, as well as the Russell and the Dow Jones, and they're all in the red today in the futures market before the market open. The VIX has broken out above a significant level, a key level that I'm going to discuss in this video. What the heck is happening? What's going to happen over the next, let's say, 2 to 6 weeks? We'll cover all of it. So let's get straight into it. And today I want to start with something a little bit different. I want to talk about what's happening in the Middle East, specifically with the US and the British government bombing Yemen. What has that led to? Well, it has led to this. Take a look at what's happening with naval shipping. This is the marine map for naval shipping back in November of last year. This is the updated look for this month. Look at this entire shipping line. It has entirely shifted from going through the Red Sea and the Suez Canal to shifting south through South Africa. Now, this huge detour has led to the rise of shipping costs by 137%. In fact, I saw other sources talking about shipping costs rising by 250% for all goods traveling from Asia. That means China, Japan, and India into Europe. All of these shipping routes have shifted south. This has led to a huge inflation in shipping costs. That means Europe is going to get hit once again by another major wave of inflation. Unfortunately, this also means that the US and the global economy is going to suffer from a second wave of inflation simply due to the instability of the Red Sea as a shipping route, as the Houthis in Yemen have been targeting Israeli ships, and now the British and the US have been targeting Yemeni ships, so they're now retaliating and targeting all US ships. This escalation is only going to get worse. It's not going to get resolved anytime soon. We'll likely see something like this last for 2 to 3 months, with each month seeing costs rising, shipping costs rising, and as a result, you're going to see direct effects on things like car prices, fuel prices, gas, all of that stuff in Europe. Now, obviously, direct shipping routes from Asia to the US exist through the Pacific Ocean, so those are not going to be affected as much. However, all trade between Asia, the Middle East, and Europe is going to be directly affected. So what is the result? This is the direct result, legends. Look at this. Oil futures up, gasoline, heating oil, all of the US indices, the Russell small caps, S&P 500, and the NASDAQ 100, both down massively in the pre-market session. The VIX again breaking out at a key level and overtaking another massive level that usually tells us that the market uptrend has actually ended. It is over, and we're now entering a downtrend. So let's start straight with the VIX, because this is a pretty significant development that I want to cover today. And as you can tell, legends, we're now above the 50-day moving average. This green line, whenever we're above the 50 moving average on the VIX, it means that the market, which is down below, this is the S&P 500, it means that the S&P 500 is effectively in a downtrend. And it's a very clear-cut correlation. A break above the 50-day moving average, VIX continues to rise, S&P 500 gets crushed. Again, VIX break above the 50-day moving average marks the turning point, the end of the uptrend and the beginning of a new downtrend. We're now getting the first breakout above the 50-day moving average, and odds are we are going to close above it this week. That means the uptrend is officially ending this week. This move in the S&P 500, as we've been calling for the entirety of last week, is a counter trend rally. Effectively, the uptrend ended with this double top. We got a counter trend rally that was overextended, which can happen sometimes. We're going to discuss that. I'm going to cover that in the daily chart. And now this overextended counter trend rally is ending, and we're now getting to see the 3-month sell-off that I've been discussing for a while now. It is now finally beginning. Okay, so let's take a look at the daily chart for the S&P 500. Last week, we had the close of the week with 2 of these hammer candles slash hanging man candles. Now, legends, these hammer candles, when they form at the bottom of a trend, for example, here, as well as here, they usually signal, as well as here, they usually signal the end of a medium-term, short-term downtrend and the beginning of a new uptrend. When they form at the top of a trend, for example, right here, that usually means the uptrend is over and we're getting a new downtrend. So they're reversal candles. When you see them at the top, that means the market is stopping. When you see them at the bottom, it means the market is bottoming. Let's highlight some of those. Here's an example. Inverted hammer candle, another hammer candle at the top, we got a sell-off. 2 inverted hammer candles, we got a local bottom, a rally. Again, 2 hammer candles, and that usually indicates the beginning of a sell-off. Now, this stands true throughout uptrends and downtrends. For example, here, inverted hammer followed by another hammer candle called the top, we got a sell-off. Another hammer candle called another top, we got a sell-off. Again, 2 inverted, one big hammer candle, another smaller hammer candle, inverted hammer, got the top and a sell-off. Again, legends, hammer candle, sell-off, inverted hammer, sell-off, multiple hammer and inverted hammer candles, sell-off, inverted hammer, sell-off. This has happened systematically. Another one here, inverted hammer, sell-off, a hammer sell-off, a hammer candle, another sell-off, another hammer candle, sell-off. Again, right here, inverted hammer followed by a hammer candle at the top of a trend, and we got a sell-off. So this is a very clear-cut technical structure. We now also have it coupled with a negative divergence on the PPO and the RSI. That is the S&P 500 has made a slightly higher high. The PPO and the RSI both failed to form a higher high. They formed a lower high. That's a clear negative divergence. And if we take a look at the futures market, this is the 4-hour futures. Look at this clear single rejection, double rejection, sell-off, single rejection, double rejection at the same level of resistance, sell-off. We're now breaking below this key support line, this moving average, the medium-term moving average, the blue moving average. And we formed this quite large double top. You can also call it a head and shoulders top, right head, right shoulder, left shoulder. Unlike the S&P 500 ETF, the futures have actually failed to make a higher high. That's another negative divergence. To know exactly what I'm buying, when I'm buying it, what price, when I'm selling, every single trade and investment, this is the only way to get access to all of that. Once again, legends, thank you so much for your legendary support. We take a look at the weekly chart below here. In the green and red, we have the McClellan oscillator. Above that, we have the bullish percent index. What usually happens, legends, when we get a bearish divergence at the highs above the 80 reading, and then we break down, we nearly always, legends, get the beginning of a new downtrend. We did have the exact same setup here. Bearish divergence, double top with a lower high on the bullish percent index, broke below, and we're now getting the beginning of a new downtrend. Now, in the very short term, legends, we could still see a lot of volatility here before we actually get the continuation of the sell-off. We could also simply begin to sell off immediately this week and we get a red week. That is also possible. The best example that I could give, legends, is when your car is running out of gas, it begins to sputter. When it's really running out of gas, right? It doesn't stop smoothly and then it just stops. It begins to sputter. We call that in the market a volatility expansion pattern. When you see volatility expanding at the end of an uptrend, at the top of an uptrend, it usually tells us that the uptrend is ending, the market is stopping, and we're getting more and more aggressive selling, and that drives the volatility. What do we mean by volatility? We usually mean, legends, big candles. We get gaps to the upside, gaps to the downside, a lot of really messy period of trading. And this period of trading is synonymous with that because we got gap up, then gap down, rally, huge sell-off, another rally, big sell-off, another rally, fails at the same resistance level. And we're now getting a huge gap down with a breakout in the VIX. That's never a good sign. We need to see the VIX breaking out as the market, after the market has already rallied by 16+% from the bottom to the top. Does it make sense to try and catch this pullback to ride the market higher? It absolutely makes no sense, right? The market has already rallied by 16%. We have now negative bearish seasonality. We're entering bearish seasonality. February and March tend to be negative months. We also have multiple bearish divergences, and we have the VIX breaking out, and we have key indicators like the 50-day and the 200-day breadth indicators all breaking to the downside. I discussed this at length last week. Look at this. This is the 50-day breadth for the S&P 500, and it looks at the percent of stocks in the S&P 500 index that are trading above their 50-day moving average. And what do you notice, legends? This indicator has been moving down as the market has been inching higher. We call this a clear negative divergence, lower lows, higher highs. The market will inevitably always catch up to what breadth is doing, and breadth has been consistently declining throughout this last 2 to 3 week period of volatility. What about the gold standard 200-day breadth? Exact same look. We've broken below the 5 and 10-day moving averages. Usually the break below the 10-day called the top in the market. So we got that. It called the top. We got a counter trend rally in the market. That counter trend rally is now failing. We had two indecision red hammer candles, hanging man candles at the top of a trend. They're reversal candles. We're now getting a gap down this week. Just as we expected, we talked about this extensively last week. We said the market will likely top at the end of the week, and we're going to see the selling begin this week. What about other key trend indicators like the McClellan Summation Index for the NASDAQ Composite? Notice we crossed down over a week ago. The oscillator remained in red even though the market was rallying. Oscillator continued to make a lower low. This is a clear negative divergence. What about the New York Stock Exchange Summation Index? Exact same look, lower low on the oscillator, crossed down last week as the market continued to form this nasty bull trap, and now beginning to sell off, rejecting at resistance and beginning to sell off. Again, does that completely rule out any short-term rallies, volatility throughout this week? It does not. However, I would say 90%, we have 90% odds that the market actually topped last Friday on an intraday basis. And we have 10% odds that we're going to see a lot of volatility this week with the 10% chance of a higher high, 90% chance volatility, lower highs and lower lows, and we continue lower all the way to 458 by the end of the month into early February. Now let's take a look at what the smart money has been doing. Up top is the smart money. Down below is the S&P 500. Dumb money, right? The stock market is usually not as intelligent as the bond market. Bond market traders tend to get it right more of the time. It is a significantly larger market. It drives 4/5 of what happens in the entire market. So what's been happening in the bond market that smart money has actually been selling? Smart money formed a lower high as the market formed a slightly higher high. We talked exactly about this scenario in the last couple of videos. I said that smart money will inevitably form a lower high. The S&P 500 will form a slightly higher high at the end of the week. That's exactly what happened. We're now getting a rejection in both the smart money and the dumb money. The dumb money is now finally following the smart money. This bearish divergence nearly always leads to a top, either a local top or a medium-term top. It doesn't matter. Nearly always leads to a top. We now believe the market has stopped last week and is now beginning the 3-month sell-off that we expect to end at the end of March. Now, if we take a look at the momentum for the smart money, we also got this very clear bearish cross down. We got a back test of the PPO. It failed. It usually fails nearly always. And we're now getting this gap down to start the week. A very clear signal that the sellers are back in control of this market. Take a look at the 10-year yield. Why do we follow the 10-year yield? Well, legends, because yields are directly inversely correlated with the S&P 500 and the broader market. Up top is the 10-year yield. Down below is the S&P 500. We got a breakout today above all key moving averages in the 10-year yield. We do expect the 10-year yield to continue to rally all the way to 4.25%, so 4.25%. That opens the door to breaking this key support level at 468 on the S&P 500. We expect the sell-off to continue all the way down to 458 again by the end of this month into early February. We expect that to happen as the 10-year yield continues this counter trend rally into that 4.25% target. Okay, what about the dollar index? Again, clear breakout above the 50-day moving average on the dollar index. This always correlates with a negative period in the market. Take a look at this, broke above the 50-day moving average. It called the top perfectly. The market has been selling off since then until it formed that bottom in October that we called to the exact day. So what does that tell us? Well, both the dollar index and the VIX, the volatility index, they're both now telling us that the market uptrend has effectively ended and we're now entering a downtrend, a new downtrend that we expect to last into the end of March. We take a look at some of our long-term key indicators like the put-to-call ratio, the PC put-to-call ratio. It called the top perfectly in the middle of the summer rally. It called the bottom perfectly in October, and it has now called the top yet again. It has been continuing to rise. The PPO has been inching higher as the put-to-call ratio has been expanding. That means market participants are now beginning to buy more puts relative to calls. That means the consensus is now shifting from bullish, from an uptrend to a downtrend. This is a proprietary Money Time Machine indicator that is available to all Money Time Machine trading community members for free. You get access to all of my indicators, including this indicator. You will not find it anywhere in the world. I developed this myself over the 2022 bear market, and I put it out there, and I've been continuing to follow it, cover it, and refine it to suit the market conditions. It has called key turns in the market perfectly for the last 2 years. Let's take a look at the fear and greed. We are now at 71 greed reading as the close of last week. We've been forming slightly lower highs and lower lows on the fear and greed reading. If we take a look at the stock market strength, clearly now turning down. Stock market breadth clearly turning down after forming a top. Put-to-call ratio has been steadily rising. I've been covering this. The VIX, the 50-day crossover has happened today. This is a major development. It nearly always means, legends, that the market trend is switching from uptrend to downtrend. That means we do not want to be buying pullbacks at all. We want to be selling into strength and not buying into the weakness, because the lows will be followed by lower and lower lows. What's happening with the bullish percent index? I covered this extensively last week. Look at this huge negative divergence. Bullish percent index formed a top 2 weeks ago. It formed a lower high last week. Even though the market has been rallying, we got a cross below the 70 reading on the RSI for the BP-SPX. That nearly always corresponds with a top in the market and the beginning of a period of weakness and risk that happened last week. It has continued to happen. This bearish divergence is now in place, and it's telling us this counter trend rally last week is merely a bull trap. Odds are overwhelmingly against higher highs forming here, and odds are overwhelmingly in favor of the market starting a downtrend, forming lower highs and lower lows. In terms of economic events this week, not a lot going on. We do have retail sales coming out Wednesday, and we do have building permits coming out Thursday, as well as some initial jobless claims data. Friday, we have the Michigan Consumer Sentiment Index. In terms of huge economic events, not a lot going on in terms of economic data this week. However, we do have more and more companies reporting earnings this week as we kick off the earnings season, which brings me back to the XLF, the S&P 500 Financials ETF. Look at this, what has happened last week. We closed the week with a bearish engulfing candle on the XLF, exactly as we predicted. We called the top on a closing basis. Here we said we're going to get a counter trend rally as we broke the support line of this ascending wedge. We now expect the XLF to sell down all the way to 36.2, then move lower to fill the gap at 33.9. That means overall about a 10% correction from current levels. We expect this correction to last into the end of March. And this has happened systematically. We nearly always get a big rally in financials ahead of Q1. Then as Q1 begins and then those big banks begin to report earnings, we nearly always get a reversal of this huge rally. Again, it has happened systematically in the past, nearly always going back all the way, legends, when the market was actually forming that massive top after the injection of liquidity. The market topped, financials formed this high with a huge bearish divergence on the PPO, higher high on the daily chart, lower high on the PPO, broke below the 200-day moving average. That was the first warning sign. From the lower lower high, then continued to sell down from that point forward. So to summarize, legends, counter trend rally now ending. We have formed this very clear, if you take a look here, legends, this is a rising wedge, another key rising wedge. We are now breaking below it, just like what happened 2 weeks ago. The exact same thing is now happening. We could get another counter trend rally. That will almost certainly fail. 90% odds that we're now going to make lower lows and lower highs and not higher highs. The VIX has broken above the key 50-day moving average. Now, this is not confirmation of a new downtrend. We do need a close above the 50-day moving average for 2 consecutive days. When that happens, it always confirms the beginning of a new downtrend. So if we get a close above the 50-day today and tomorrow, even if we get a counter trend rally today and a bit of a recovery to start the day, if we close above the 50-day moving average for 2 consecutive days, that will confirm the beginning of a downtrend. We're getting XLF topping, financials topping, which is typical of this time of the year. We are continuing to see breadth collapsing, the 50-day breadth and the 200-day breadth at a key resistance level at which every single rally so far for the last 12 months has failed. We're now getting failure at the exact same level yet again. We're getting the exact same look on the 200-day breadth and the 50-day breadth. Again, same exact key resistance level and failure. PPO about to cross below the zero line. That's a huge negative catalyst, bearish catalyst if that happens. And it is likely going to happen by the next 10 trading sessions. Key trend indicators like the summation index for the NASDAQ composite has crossed down, continued to move lower. Oscillator continued to move lower despite this counter trend rally. Same exact look on the New York Stock Exchange summation index, continued to move lower. Crossed down last week, continued to inch lower. Put to call ratio continues to print sell signals, confirmed with multiple histogram readings on the PPO. Both the PC and the CPC have both triggered sell signals. We got a breakdown in the XLY divided by XLP, that is consumer discretionary divided by consumer staples. This is a key chart to look at because, legends, if you notice here, we formed a massive bearish divergence, significantly lower high on the ratio chart versus the S&P 500. Why does that matter? Well, we need to have consumer discretionary sectors leading versus consumer staples, defensives, in an uptrend when the market is bullish. When you see a huge breakdown like this, a bearish divergence like this, it always tells us that the market is now switching from being bullish to bearish and it's positioning itself defensively. And that's why you're seeing this breakdown in the ratio chart. We're getting a breakout in the dollar index and the 10-year yield. Basically, legends, every single trend indicator that we follow Every single one has printed a sell signal as of this morning. Every single one. That includes the daily chart for the S&P 500. That includes the summation index for the NASDAQ composite and the S&P 500. So that's number 2. Number 3, the VIX. Number 4, the DXY, the dollar index. Number 5, the US 10-year yield. Number 6, the 50 and 200-day breadth charts. Number 7, the smart money forming a bearish divergence. Number 8, XLY divided by XLP, the ratio chart forming a bearish divergence. So we have A, bearish sell signals, 0 buy signals, no buy signals in any of the indicators that we follow, all telling us the market is stopping, the uptrend is ending, the downtrend is now beginning. If you found value in this video, do not forget to smash the like button. That's the best way to support us, and it's completely for free, legends. If you like these videos and if you want me to continue to upload these key updates, the best way to show me that you want these videos is to smash the like button. We want 1,000 likes on this video. And if you watched the video till the end and you did not enjoy it, I do thank you for your time and attention. That's all I have for you today, legends. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.